Advanced Audit and Assurance, Chapter 6, the Audit Approach Continuation. Section 3.7, Monitoring of Controls. It is important within an internal control system that management should review and monitor the operation of the controls on a systematic basis to satisfy themselves that the controls remain adequate and that they are being applied properly. ISA 315 requires the auditor to obtain an understanding of this monitoring process. Section 3.8, how the auditor uses internal controls. When a client operates an effective system of internal control, the most efficient method of generating audit evidence normally involves the testing of controls where possible, rather than substantive procedures. System-based techniques therefore complement the business risk approach described above in an effort to maximize audit efficiency and focus testing on the higher risk areas. The auditor relies on the accounting systems and the related controls to ensure that transactions are properly recorded. The audit emphasis is therefore as much as possible on the systems processing the transaction rather than on the transactions themselves. Understanding the controls. ISA 315 requires the auditor to obtain an understanding of internal control relevant to the audit. Although most controls relevant to the audit are likely to relate to financial reporting, not all controls that relate to financial reporting are relevant to the audit. It is a matter of the auditor's professional judgment whether a control individually or in combination with others is relevant to the audit. ISA 315 requires the auditor to gain an understanding of each of the 5 elements of the client's internal control system and document the relevant features of the control system. Once this understanding has been gained, the auditor should confirm that his understanding is correct by performing walkthrough procedures on each major type of transaction. For example, sales transaction, purchase transactions, payroll. Walkthrough testing involves the auditor selecting a small sample of transactions and following them through the various stages in their processing in order to establish whether his understanding of the process is correct. If he understands the controls that are in place, the auditor can go on to assess their effectiveness and the extent to which he can rely on those controls for the purpose of the audit. Assessing the effectiveness of controls. The degree of effectiveness of an internal control system will depend on the following 2 factors. 1. The design of the internal control system and the individual internal controls. In the control system, is the control system able to prevent material misstatement, or is it able to detect and correct material misstatements if they occur? Do the internal controls appear to be adequate and effective on paper? 2. The proper implementation of the controls. Controls are not effective unless they are implemented properly. So, are the controls operated properly by the client's management and other employees? The outcome of this evaluation helps the auditor to assess the control risk. This is the risk that the internal control will fail to prevent or detect and correct errors in the financial statement. This evaluation will allow the auditor to decide on the extent to which he can take a system-based approach to the audit. Section 3.9, the auditor's evaluation of internal controls. The auditor may judge that the control risk is high or that the control risk is low because the internal controls are effective. If the auditor assesses the control risk as very high, it will probably take the view that a system-based approach will not be appropriate. It will therefore move on to detailed testing of transactions and balances and take a substantive testing approach to the audit. Before he can assess the control risk as low, the auditor must be satisfied that the controls are well designed and should be effective. In other words, they seem effective on paper. Even if the control appears to be acceptable on paper, the auditor cannot rely on them and perform a system-based audit unless he is confident that the controls are actually working in practice. In this situation, the next stage in the audit process is to carry out tests of controls. If the outcome of the test of controls indicates that controls are actually operating effectively, the audit can use a system-based approach with a reduced amount of substantive testing. Even if the internal control system seems to be effective, the auditor will never rely 100% on his assessment of the controls. He will always do some substantive testing before reaching his conclusion about the financial statement. This is because of the limitations that are inherent in all control systems. It is impossible to avoid the risk of control failure that is caused by human errors and a failure to apply a control properly, overriding of controls by management, which is a deliberate decision to ignore a control, and the possibility of collusion and fraud. Auditors will always supplement their work on system with some substantive testing. The amount of this testing will depend on the auditor's evaluation of the effectiveness of the controls. Summary of the approach to reliance on internal controls. The auditor's use of a system-based approach to an audit is summarized in the following flowchart. At the top of the flowchart, we have planning and risk assessment, which flows down to two parts: assessment of internal control as weak, and the other part is assessment of internal control as strong. Under assessment of internal control as weak, we have extensive substantive testing. Under assessment of internal control as strong, we have tests of controls. Then, if there are good controls, we reduce substantive testing. This will give us overall review of financial statements. Then we can issue audit reports. Subtopic 4, the Statement of Financial Position Approach. Section 4.1, Substantive Test. When an auditor assesses the control risk as high, he will not be able to adopt a system-based approach to the audit. Instead, he will carry out extensive substantive testing. Substantive tests are audit procedures performed to detect material misstatements in the figures reported in the financial statement. They are designed to obtain evidence about the financial statement assertions. They include tests of detail on transactions, account balances and disclosures, and analytical procedures. Section 4.2, the Statement of Financial Position Approach. The Statement of Financial Position Approach is also an approach to the audit based only on substantive testing. However, with this approach, the auditor concentrates primarily on 1. Testing balances as opposed to 2. testing balances and transactions. It is an approach that is often well suited to small companies and to companies where assets and liabilities are substantial in relation to transactions, e.g., investment companies. This approach is based on the following accounting equation. Opening net assets plus profit for the year is equal to closing net assets. The theory is that if the opening and closing statements of financial position are correct, then the profit for the year must also be correct. Section 4.3, Smaller Entities. ISAs apply to the audit of all entities, whatever their size. However, additional considerations specific to audit of smaller entities are included within the application and other explanatory material of a ISA where appropriate. These additional considerations assist in the application of the requirements of the ISA in the audit of such entities. They do not, however, limit or reduce the responsibility of the auditor to apply and comply with the requirements of the ISAs. Definition: small entity. The IAASB's glossary of terms defines a smaller entity as one which typically possesses the following characteristics. 1. Concentration of ownership and management in a small number of individuals, often a single owner manager. 2. One or more of the following: uncomplicated transactions, simple record keeping, few lines of business or product, few internal controls, few levels of management with responsibility for a broad range of controls, few personnel, many having a wide range of duties. Nigerian Auditing Practice Statement (NAPS) 2 defines small entity as an entity where one or more of the following are also profound: few sources of income, unsophisticated record keeping, limited internal controls, together with the potential for management override of controls. Many of the control activities that would typically be found in a large company may be inappropriate, too costly, or impractical for a small entity. Segregation of duties is an obvious example of this. Smaller entities do not have enough employees for an ideal segregation of duties. Often, control systems in smaller entities are based on a high level of involvement in day-to-day operations by the directors or owners of the company. Authorization controls and review controls, with the owner manager personally authorizing many transactions, might therefore be a key feature of the control systems in smaller entities. Although the active involvement of an owner manager might mitigate risk arising from a lack of segregation of duties, the auditor will often see the involvement of an owner manager in day-to-day operation as only a partial substitute for normal control systems. The following problems may arise in such types of businesses. 1. There may be a lack of evidence as how systems are supposed to operate. The auditor will need to rely more on inquiry than on review of documentation. 2. There may be a lack of evidence of the application of controls in practice. For example, authorization may not be documented. 3. Management may override whatever internal controls are in place. 4. Management may lack the expertise necessary to control the entity effectively and efficiently. 5. There is unlikely to be any independent person within the management team, as there would be within those charged with governance in a larger entity. The attitude and actions of the owner-manager will be key to the auditor's risk assessment. There is unlikely to be a written code of conduct, so a culture of integrity and ethical behavior, as demonstrated by management's example, will be important. The auditor needs to understand and evaluate whatever controls are in place and plan his audit work accordingly. However, it is likely that a lower level of reliance will be placed on controls in a smaller entity, which means that a considerable amount of substantive testing will be needed. Subtopic 5, Chapter Review. Before moving on to the next chapter, check that you can 1. Summarize the different types of audit strategy and factors that impact which strategy is adopted. 2. Explain the business risk approach and be able to identify and assess business and financial risk. 3. Describe the system-based approach and articulate the components of a system of internal control. 4. Summarize the statement of financial position approach. Quick quiz question. 1. If inherent risk and control risk are high, which of the following is most likely? A. A business risk approach to the audit. B. A substantive approach to the audit. C. A modified audit report. D. Greater reliance on the work of internal audit. Answer is B. If inherent and control risk are high, then a substantive approach is likely, involving much detailed testing of transactions and balances. A business risk approach is unlikely to be appropriate due to the scale of the risk and the need to reduce audit risk to an acceptable level. Question 2. The 5 elements of an internal control system identified by ISA 315 are the control environment, the risk assessment process, internal control, monitoring of controls, and options. A. The information system. B. Management responsibility. C. Personnel. D. The organization structure. The answer is A.